I have for a while been advocating that Pillar 2 is not as difficult as most of the critics want you to believe that it is. I have been working for a while on developing a tool, simple Excel with some Python background, working in the background, to make Pillar 2 returns and convert them into XML in such a way that they validate for the OECD XML schema. I've done that for CBCR for years now. And I thought it's time to put my money where my mouth is. So what I want to show you in this video is why I do not think that Pillar 2 is as difficult as its critics would like you to believe. And it comes down to a number of things. One, the CBCR safe harbors and the other safe harbors saves you 90% of the work. Two, the countries that are left where you need to do your calculations, 90% of the rules that complicate Pillar 2 will not apply to you because typically you would not have transparent UPEs. You will not be in shipping. You will not hold minority-owned entities of 30% or less for which you have control, and you will not have PEs all over the place, or for that matter, 50-50 joint ventures. Let's get started. I wanted to know what most of the companies out there consist of for Pillar 2. So I started with companies that make stuff and sell stuff. And I say, what is the ratio of manufacturing companies to other distribution companies, etc., in the group? And at first it came out with some weird numbers, much more manufacturers than distributors. And I said, this makes no sense. And then it turned out that the databases tend to look at big companies only, which means they exclude smaller distributors. Once we fix that, you can see that the M&Es with 30 to 300 subsidiaries making stuff and selling stuff, about 60 to 80% are distribution companies, relatively simple. Another 10 to 25 are manufacturing companies, maybe slightly more complicated because of depreciation, etc., but nothing special. And then the other 5 to 20% is head office, logistics, IP, service centers, etc., etc. But of course, there's not only manufacturers in the world, there are also service providers. And I've worked with some engineering groups. So I said, tell me how this differs for service providers like engineering groups and others. And you can see here the numbers saying, if you look at engineering groups with about 20 to 150 subsidiaries, 5 to 15% consist of global HQs, regional HQs, etc. And then the other 70 to 85 are local companies providing engineering services. In the 5 to 15, you also have centers of excellence and expertise, etc. But this is it. The vast majority are just ordinary service providers. And if you move to other large enterprises, I'm leaving out a couple of categories here simply to save space. And if you look at the conclusions, you can see other large service industries. We're talking advertising, education, logistics. 60 to 90% consist of local companies delivering services, right? 10 to 20, maybe 30% are HQs, creative hubs, regional hubs, things like that, maybe service centers, nothing special. And the conclusion is, if you look at service M&Es, they tend to be very big, very local. And the reason is you need local professional licenses in many cases. You need proximity to clients. You need cultural fluency. And you can stop there, right? Because it makes sense. So most of the world's companies are not, like the critics of Pillar 2 would like you to believe, transparent UPEs in Estonia or Latvia, or shipping companies, or PEs from hybrid JVs or anything like that. These are just ordinary companies just getting the job done. It's not that complicated. Let us start with a very simple CBCR, right? So for now, I want you to ignore the red block here. This is just for later in the program if we have subgroups that we need to deal with them. But again, that will be the minority of cases if you were to have joint ventures or minority-owned parent entities or something like that. But that does not apply here. Most companies do not have that kind of stuff. And we've got a number of countries here now, CBCR, and we've got the numbers filled in. So let us work with this. Let us now collapse the CBCR. So we only keep the columns that we need, right? We need the revenue, we need the earnings before tax, we need the tax accrued, and we need the assets. Then we add the other assets in case we need the different numbers for the UTPR and the substance-based income exclusion. Because we work with carrying values and year average values, we add deferred tax and uncertain tax columns so we can calculate our adjusted covered taxes, and then we can calculate our effective tax rates by dividing the income tax by the profits and loss, right? And then we can see whether we have safe harbors or not. First of all, if we look at the CBCR de minimis safe harbors, we can see we have 2 here. We follow the countries through. It seems like we're looking at Czech and Argentina, where the revenue is less than 10 million and the profit is less than 1 million pounds in this particular case, yeah? If we look at, for instance, the countries number 1, 2, 3, and 4, we are under the routine profit test safe harbor, because if we look at our substance-based income exclusion towards the right, we can see we have 4.5 million and 4.5 million and almost 2 million. And if we look at the earnings before tax of these countries, we can see that is 4 million less than 4.5 million, because the other one was 4.699. This is 4.5 and 4.5 and 38,000. So they are covered by the routine profit test. And then we've got, of course, the effective tax rate, which we can also see whether we have more or less than 15%. And I think I sorted the effective tax rate here by size. So what we end up with here is these countries that do not have a red block in the column for safe harbor roll out under some kind of CBCR safe harbor, 1, 2, or 3 of them, as you can see by the GIR numbers under the safe harbor column. And we're done with these. We do not need to go further. We need to work out what we are going to do with the countries that are red, which is the Czech Republic, and it is Peru and Vietnam and Poland by the looks of it. So we will pick it up from here. Now, bear in mind, again, if the results look unrealistic, I obviously have not taken the actual numbers. I've mixed the numbers. I've mixed the countries in this particular case, but it is based from a real case, and we had about 4 or 5 countries in the actual case out of the number of countries where this group was operating. So let us look at the difference between having a CBCR safe harbor and not. This is your globe information return with a CBCR safe harbor. You're going to do your corporate structure and everything, and then you're going to fill in section 2 of your CBCR safe harbor, but then you're done. If you are not in a CBCR safe harbor, this is your globe return. I mean, you have a lot more work to do. So clearly, the 4 the countries where we are not in safe harbor is going to be more work than a safe harbor, but look at the amount of work you saved for being in the other safe harbors. If we start with our 4 countries in Peru, Poland, Switzerland, and Vietnam, where we want to do the full Pillar 2 calculation, I want to show you how many boxes you leave empty, right? So we will start here on a jurisdictional on an entity basis. You can, during a transitional period, do everything by jurisdiction only if you want in most circumstances, but let's stick with the entities and then go to the jurisdictions, because that is also the way the XML schema is built up. So you're going to start for these entities with your net profits in your annual reports. You are always going to add back the taxes. There's no escaping of that. So you will always fill in 3241A3A, dealing with Article 321A on net tax expenses. That will go back. And then you will, if you didn't pay out dividends, or if you didn't have any capital gains, or if you didn't have any bribes, or you didn't have any under policy disallowed expenses, and you didn't have any accrued expenses, pension which you haven't paid, and you're not in that kind of system that triggers it, and there are no stock options, you're done with this part of the globe information return. Then we need to look at the other changes that potentially you need to make to your globe income. Again, in most cases, you're not going to be in international shipping. I don't know whether you are in Estonia or Latvia, where you have a taxable distribution method or anything like that, or deductible dividends. But otherwise, your globe income in the far right corner per entity is going to be your net income added back the taxes, and you're done. And then when you're going to add all of this on a jurisdictional basis, you're going to start with an adjusted final per jurisdiction. And so what will happen is, if we had 2 or 3 subsidiaries in Peru, we would have added all of those together, and we would have plugged in the number here at the bottom, and we would have done the same for the net tax expenses. And then all the other boxes, again, between GIR 202 and 2026 will be empty, and we will come to our globe income calculations on a jurisdictional basis for the companies or countries where we are not in a transitional CBCR safe harbor, or for that matter, in a permanent de minimis safe harbor. After we've calculated our globe income, we would need to calculate our adjusted covered taxes. And I will start with the deferred tax, because here you are going to need to make the recasting adjustments, and I just want to show you what's going on. So you'll plug in the deferred tax expense from your annual report. You will make adjustments like you would have made for the globe income. If there was not an adjustment on the globe income, there's unlikely to be an adjustment in the covered taxes. And then you will come to your total preliminary deferred tax expense. Now you would need to look at what your local tax rate is, right? So we will have to fill that in the far right column, and we would need to recast those taxes higher or lower, and then we would come to our deferred tax adjustment amount. You see, I've got a negative amount there. We should have maybe turned that around. But anyway, we would need to calculate our deferred tax adjusted amount. And when we have that, we can calculate our adjusted covered taxes, because we start with the current tax amount in the financial accounts. Again, like we did for most of the global income, we skip all these boxes. We didn't have uncertain tax provisions. We didn't have any adjustments that were in the global income. That has a knock-on effect to the taxes, because remember, if you take income out of the global income or add it back, you also need to do the same with the taxes in the deferred and the current taxes. So the only thing we need to plug in is our total deferred tax adjustment amount, because we now have our current taxes plus our deferred tax adjustment amount, which we get from our adjusted deferred taxes after recasting. And then we come to our total adjusted covered taxes. We're doing this on an entity basis still, so we also need to plug that in on a jurisdictional basis. And again, you can see we have our final, and we have our adjustments to our global income, which is not relevant. We end up with adjustments basically final plus tax expenses. Now we look at our adjusted covered taxes, which we will find back here in the two boxes above, because those were the entities, and we add them up to get to the totals per country. We come to our adjusted covered tax amount. We can now divide the adjusted covered tax amount by the global income to calculate what our effective tax rate is, and then we can deduct that from 15% to come to our top-up taxes. I'm sorry, but so far I do not think we've done anything that involves rocket science. Once we have done this, we can now calculate our top-up tax. We are going to take our global income. We're going to fill in. We've already looked at these boxes because it's all on the same sheet. We filled in the current tax amount, the adjusted covered tax amount, the deferred taxes, the top-up tax percentage. We stopped here in the previous slide. Now what we're going to do is we're going to add our payroll, and we're going to calculate our total substance-based income exclusion. We're going to deduct the substance-based income exclusion. There's 1.7 million from our global income, which is 8.2 million almost, and we're going to end up around 6.4, 6.5 million in excess profits. We're going to multiply the excess profits by our top-up tax percentage of 5%. That should give us around 300,000, and lo and behold, we have 300,000 that we need to pay in top-up taxes, and 35 and 341 and almost 20. So let us look at who pays what. So if we now look at our calculation or allocation of the IRR, we will need the company, we will need the subgroup that they are in. We've already done that in our facts, where we described the activities of the different companies for CBCR purposes, and we need to add to that a number of columns, including the type of globe entities that these are. We need to add in who the shareholders are, and from that we can now calculate and allocate the IIR. We're going to have the top-up tax amount, which we've got from the previous slide. We're going to look at what the net global income is, and you need this if you have more than one entity in a jurisdiction. You need to allocate those top-up taxes on a pro rata basis based on the net global income. For instance, if you have different shareholders to which the IIR must go to. We look at the top-up tax of the low tax constituent entities, and we determine who the parent is. We calculate their ownership ratio, we calculate their inclusion ratios, and then we calculate the top-up taxes for them. I give a brief description of what the whole process looks like here at the top. And if we have entities with more than one shareholder, we would also, for those entities, need to include the other shareholder. So we now have shareholder number 2 in this particular case, which holds 0.008% of our Peruvian entity. It might be a country like Belgium, for instance, where you're not allowed to have a company with one shareholder only. So besides the 357,000 that shareholder number 1 holding 99.9992% is paying, the other shareholder needs to pay 286 pounds as well. So these are our IIR allocations. We are in the UK, so there's no issue about UTPRs because the UK applies the IIR regime. We do not need to worry about the UTPR, and now we can move on. If we now look at the conclusions of what we're doing, we will say, one, we started with 42 countries in our CBCR, which we were going to make in any case, right? We ended up with 4 in the IIR. That is 10% of the total countries where we are operating. And remember, I showed you the boxes of the number of pages on the Global Information Return that we do not have to fill in for 90% of the countries, right? Then for the ones that we need to fill in, more or less 90% of the boxes for adjustments were left out. Remember, for the global income, you've got 26 adjustment boxes to make. We used one. Yeah, we added back the tax. Now, the question is that realistic? And I think it is, because one, we did not have any partially owned parent entities. We did not have any excluded entities, which most groups do not have. We were not into international shipping. We did not have flow-through entities. I think nowadays, after BEPS, actually do very few countries do. We didn't have 50-50 joint ventures or minority-owned parent entities where we owned only 30% or less of a company but still had control. And like most groups, we did not have PEs. Now, you may have one or two PEs. If you do, it is not the end of the world. Those PEs appear on the CBCR already. They qualify for safe harbors like normal constituent companies do. The complexity that gets thrown up is you are required to show the allocation of income and taxes between the PE and the head office. And if you are in a credit system instead of an exemption system, you are going to throw back the additional taxes paid by the shareholder or the head office for the profits of the PE, if applicable, and you will allocate that to the PE country. It is about 10 extra boxes. I've done the exercise that needs to be checked. We could have allocated CFC taxes. It's not impossible that you are in the UK where you have CFC regimes. We could have allocated dividend withholding taxes, and we did not. Now, on the one hand, you may accuse me of oversimplifying things here. On the other hand, part of the reason why we did not is because we were in safe harbors. Remember, you only come to the CFC and the dividend allocations if you are not in a transitional safe harbor. So I made the assumption that for Peru and Poland and Vietnam and the other country where we were, we didn't pay out dividends and they were not subject to CFC taxes. Maybe they would have been, then there would have been a few well boxes to add on to that. If you look at our next point, we had no corporate reorgs. I think for most multinationals, you do not have a reorg every year. The one thing that I did simplify in this example is if we were transitioning into Pillar 2, like we did for these 4 countries where we had to allocate the IIR, we would have had to track the asset movements since the 1st of December 2022, and we would have had to use the tax basis of the sellers. I did not add that complication to this, and it raises another point. There are a number of calculations that you will make that will not be seen in your global return, but you would need to make it as backup calculations to have the numbers. I've not put in those there, but I do still think my point holds. It is generally not that difficult. The chances that you have all of the stuff that I've excluded here in your group all in one go, I think are not very great. And if you look at the IIR part of the calculation, so the last 4 countries, yes, we needed to fill in a number of boxes. But here's the thing. I think under any CFC regime, you end up filling in a lot of boxes in order to calculate what your CFC tax is. The advantage of the Pillar 2 CFC tax over most national taxes, CFC taxes, is at least here you get a credit for the deferred taxes as well. So do you think Pillar 2 is that complicated? Let me know what you think in the comments. And if you need any help, reach out. I'll be very happy to try. I can also help you with the conversions. Bye for now.